Hi all of you. Today we are going to discuss about the GAAP and IFRS. So why we are making our books on the basis of GAAP and IFRS. So every country has a set of accounting standards in which they are preparing their books of account in a GAAP. Here I have written that GAAP means generally accepted accounting principle and it is used in the US for maintaining the books of accounts, and IFRS is used in all over the globe. Approx 140 countries are following the IFRS. So I can say IFRS is used in global basis, but US GAAP is based only on a US. So here I have written that it is a set of accounting guidelines that make that have to make the financial statement for public companies more uniform, transparent and global basis. So we can say GAAP is used in US and IFRS is used in all over the globe. So we can say IFRS is more important than the GAAP. Here I have written some differences here between the GAAP and IFRS. GAAP is rule based and IFRS is more principle based. What do you mean by the rule based and what do you mean by the principle based, guys? So rule based means if the government has given some rules, means some guidelines, some procedure to prepare your books of account, so you have to follow that procedure and guidelines. You cannot deny that procedure and guidelines which is given by the government. It is a more specific, but under the IFRS it is based on your it is an option for the business that how you can prepare their books of account. It is more principle based. Principle based means you have an option. If you do not follow the IFRS guidelines, so just put a note in the notes to account that why you are preparing your books of account in different ways. So here I have written that IFRS is more principle based with general guidelines that can be interpreted and implemented in different ways. You have an option that you can follow some guidelines or procedure, or if you want to deny that procedure, you just put a note in the notes to account that why you are not following that procedure. So I think first part is clear to you guys. So our next part is board. Here GAAP is prepared by the financial accounting standard board, and IFRS is prepared by the international accounting standard board, that are IASB, and here for the GAAP is a FASB. Then our next part is, guys, inventory. You know about the I hope you know about the FIFO method, LIFO method and also the weighted average method. GAAP allowed both three methods, but IFRS does not allow the methods. It allowed only the FIFO method, weighted average method, but not allowed the LIFO method. So for more specific way, I am going to give you an example for a FIFO, LIFO and weighted average. Like we have an opening balance, uh, like we have a quantity of 1000 units and price of that units is $2, so our total balance will be $2000. After some time we have purchased some quantity, that's a 500 units, and price of that units is $3, so our total balance will be $1500. So then we are going to sell 400 quantities. So FIFO method tells us that we have to sell the first quantity, then we have to sell the second quantity, that we can say last quantity. So we will sell 400 units from the first balance, that was our opening balance, and the rate of that balance is $2. So our cost of goods sold will be $2. So our total balance will be $800 here, if you see. So whatever we are going to sell, we have to take from first quantity, and in a LIFO method we will sell from the second quantity which we have purchased, we can say last quantity. So our here we have a balance of 1000 units, then we have a price of that 1000 uh, 1000 units is 2, so our total amount will be $2000. And we have a same example, like we have introduced three $500 and 500 quantity, and the quantity rate is $3. So our amount will be 1500. Now we are going to sell according to the LIFO method, so 400 units. So we will take 400 units from these amounts which we have purchased on a last, that's a last in first out. So we will sell from the last quantity 400, the price of that quantity is 3, so our total amount will be $1200. Then we have a example of weighted average. We have an opening balance of 1000 units, and price of that units is 2 per dollar. So our total amount will be 2000, and we have introduced 500 quantity, and the price of that quantity is $3. Our total balance is 1500. So we will take total quantity, that is 1000 plus 500, and we have an amount of 2000 and 1500. So our total balance will be 1500 and total amount will be 3500. When we divide 3500 by 1500, so our rate will be 2.33. So our total weighted average price is $2.33, and quantity is 400, so our amount will be $933.33. So I hope it will help you to understand what you mean by the FIFO, LIFO and weighted average. So in a gap it allowed the FIFO, LIFO and weighted average, but IFRS does not allow the LIFO method. It prohibits LIFO method. I hope it is understandable for you guys. So now we have another part, that is a inventory write-off. Under the gap it allowed the inventory write-off but not the reversal of that write-off amount. But under the IFRS it allowed the write-off and also the reversal of that write-off amount. I have given an example here. If you see, like what we why we reducing our inventory, there are several causes. That's a inventory may become obsolete, spoil or damaged, stolen. So company write off that balance in that situation. So like we have a balance sheet balance, that's a 1 lakh amount. So when we are going in a market, the balance of the inventory amount balance, when we have checked, so our amount balance will be 60,000 rupees. So uh, because our inventory balance is higher than the market balance, so we will write off that amount from our books of account. So we will post an entry, that's a inventory write off expense account debit to inventory account whenever our inventory is coming, when we purchase the inventory. So our entry will be inventory account debit to bank. So because here our balance is reducing, so we will credit it when we purchase the inventory. So we debit the inventory when we because our inventory is reducing, so we will reduce the inventory. So our entry will be inventory write off expense account debit to inventory. So 40,000 is our loss, so it will be transferred to a profit and loss account, and our inventory account will be reduced by rupees 40,000. If you see here, I have reduce the amount from our inventory. Our inventory balance was 1 lakh, 1 lakh dollar in 2023, but if you see in 2024 I have reduced the $40,000 from our inventory value. It is allowed in the GAAP and IFRS, but reversal of that amount is not allowed under the GAAP. If you see, I have written here reversal not allowed, but does not allow the reversal amount under the GAAP. In a IFRS, it allowed the reversal of that amount. If you see, I have shown that our inventory balance was 60,000 in 2024, but after some time we came to know that our balance is 1 lakh or more than 1 lakh rupees. So we will increase that amount under the IFRS. Like we have a 60,000 balance, so we will increase that balance up to the amount of write off which we had done earlier, up to the amount of 40,000. So uh, our entry will be inventory account debit to inventory write off reversal account. So because our inventory is increasing by 40,000, so it will be debit, and inventory write off expense reversal amount will be credit, and it will be transferred to the profit and loss account. That is a 40,000. And then if you see in 2025 our inventory balance is again 40,000 rupees. I hope it will help you to understand what you mean by the reversal uh, of the write off inventory amount. So now we are going to discuss about the fair value valuation. Like we have an asset, like we have a land which we have purchased, which we had purchased in 1992. Cost of that land was $60,000, but in 2024 cost of that land is 1 lakh dollar. So according to the IFRS, it says us that we have to we have to increase the amount of that land, because we are not showing the land in a fair value, because fair value of that land is 1 lakh instead of 60,000. But GAAP does not allow to increase the value of plant property equipment. So here I have written that it does not allow fair value valuation. It allowed fair value valuation only on securities, marketable securities, you can say marketable securities. But in a IFRS, it allowed fair value valuation. If the value increase, then the the value if the value increases, then it will increase. If the value decreases, then it will decrease. Like we have a machinery of rupees of dollar 1 lakh, but after some time we came to know that our machinery value is dollar 70,000, so we will write off that 30,000 from our books of account. That is called fair value valuation. It is allowed under the uh, IFRS, but it is not allowed under the GAAP. But marketable security, only fair value of marketable securities are allowed under the GAAP and IFRS also. I hope it help you guys to understand what you mean by the fair value valuation. Now we have another part, that's a impairment. So guys, what do you mean by the impairment? So impairment is the amount which is higher than the value. Like we have a book value which is higher than the market value. Like we have an asset of rupees 1 lakh, of dollar 1 lakh we can say, But if you in our books of account, but when we have checked, it is when we have checked the market value of that asset, it's the market value of that asset will be 80,000. So 20,000 will be transferred to the uh, transferred to the profit and loss account. It is allowed under the GAAP and also the IFRS, but reversal uh, of that impairment amount is not allowed. Like after some time we came to know that we have unnecessary reducing our machinery balance, so we will increase that balance which we have, which we had write off earlier. So I hope uh, it is understandable by you guys. So next part is depreciation. Depreciation, under the depreciation, GAAP chart depreciation on an assets on a full part, full body, but in a IFRS is based on the component basis. I have given the example as below. If you see this aeroplane, there is the full value of that this aeroplane approx, for example, 1 lakh dollars. So under the gap, we will post the depreciation on a full plane basis. But under the IFRS says us that the component part of aeroplane and useful life of that part is different from each other. Like tires has different useful life, pilot compound has a different useful life, and fleet has a different useful life. Like tires has a 10 years life, pilot compound has a 5 years life, and fleet has a 7 years of life. And there is a passenger passenger seats in which has a different useful life. So we will post the depreciation according to useful life of that component, not a full plane basis. We will post the depreciation on a component basis. But IFRS tells us that we will post the depreciation on a full flight basis, full asset basis. I hope I have covered this part also. Now we have a investment property. So guys, under the GAAP, there is no difference in investment property which is used for business and rent purposes. But under the IFRS, they are bifurcated into different parts. If we use that plant property equipment for business purposes, for it, so it will be covered under the plant property equipment. But if we are going to give on a rent, eh, so so it will covered under the IAS 40, that is a investment property. So there under the IFRS, it is bifurcated into two parts. That's a IAS 16 plant property equipment, and investment property, that's a IAS 40. So guys, I hope it will help you to understand the basic difference between the GAAP and IFRS. So guys, I am making these videos for those guys who want these videos for their interviews purposes and want to enhance their knowledge. So please guys, please share these videos for those guys who want to give an interview and want to enhance their knowledges. So thanks guys, thanks for watching my videos, thanks for supporting me. Please like, share and subscribe these videos, so it will motivate me to make more videos. Thanks guys.